Chris Hallows here with Benchmark Mortgage, and thank you for joining us for our 2025 rate and housing forecast. And whether this is a primary purchase goal, or are you looking to purchase an investment or secondary residence, or if you own that home and bought in these high rate environment and are just waiting to get into that refinance, a lot of the information I want to share with you today hopefully will give you some guidance and direction. Obviously, we love to customize and strategize your plan individually, so reach out to us directly. Please enjoy as we jump through a lot of slides. Now, know that I nerd out on this stuff. I'm going to dig into it and get a little meaty, so hopefully I don't dig too much into it, but let me know as you have questions. Pause on some of these slides and let's get into it. So inflation. Okay, let's start there. That's the major reason why we've seen the massive market shift that we have over the last 24 months, right? And so when we look at inflation, and I'm going to go ahead and share a slide with you here, we can see this is a very, very important slide. And I'm going to go through it kind of quickly, but pause if you need to where the rate of inflation is positive and going up, right? And that's the blue bar, right? We haven't seen prices come down on goods and services and everything that's gone up with inflation. They're not getting cheaper. So that the Fed's goal has been to slow inflation, right? So you can see the rate of inflation. We're still heading down the highway, but we need to head down at a much more reasonable and sustainable pace. And so you can see the red bar that we've come way off of that peak, right? We went from 9+% year over year inflation, which is just absolutely wild and unsustainable, totally unhealthy for the economy, to now we're sitting at about 2.8. So that's a big shift. Now, because we were so high for so long, we need to really pace back, at least is what the Fed's goal is. So their goal is to get 2% or under 2. And so they're still on a bit of a war path there. So that's where I think it's good. And that, maybe a little quick commentary is that definitely plays into housing prices as well for a lot, but we'll talk about that in a moment as far as slow pace, not necessarily going backwards. So if we jump into the Fed dot plot, and this is a little bit more complex. So I feel like, hopefully some of you folks there that really watch markets, this will speak a little bit more to. The Fed then lowering their Fed funds rate is not a direct control of mortgage rates. If they lowered 0.25%, then we're not seeing a 0.25% rate reduction on mortgages, but them lowering is a positive sign typically then for inflation, positive feeling on inflation going the right direction. So that sentiment can help mortgage rates. And so the Fed did revise in December down to saying about 50 basis points, or you can see the majority of members then planning for about 50 basis point cut in 2025. We'll have to see, right? It's a live breathing thing of inflation, and it's very much a lag effect that they have to try and anticipate here. But that gives you kind of an idea on then where the Fed will sit with as we anticipate that. So that gives a little bit more concern that they're still definitely on a war path to get rid of inflation. And what that does then to our thoughts and projections and some experts that were listening out there is basically getting core inflation down to 2.1 to 2.2 from the 2.8. So definitely we should hopefully through the year see that positive projection on inflation. Now, what that could do for then mortgage rates, let's talk through that, because calming inflation is going to, let me actually jump into this next slide for you guys here. Calming inflation, the projection, if we can just start to see some normal market expectations and activities, is likely going to have a downward momentum on interest rates. And if we pool several different economists and their projections, you can see, we're sitting somewhere in the on a 30-year fixed primary mortgage, somewhere in the high 6s, low 7s, and then believing that we'll be somewhere down into the high or like low 6s, some projections in the high 5s, and over the next 12 months, right? So we're just gonna have to watch that very, very carefully. So upwards of over 1% reduction in interest rates is what we're kind of seeing on this chart. And I thought this chart was super, super helpful, especially for those with refinance hopes and intentions, right? We were so hopeful for a lot of folks in July through September that we started to see some good dips and getting close to that range for refinancing at low cost. Didn't quite get there. So we're still exercising that patience. But if you look at 450 to 650 loan amounts, you can just see the sheer impact of that interest rate drop, right? So we are off of those highs in the mid 7s right now on a primary purchase. But you can see, as you see in this chart then, that 1% dip is very, very significant on what that can mean for monthly payment. So, great for affordability down the road, great for the folks refinancing. But let's talk about what we think that's going to do to home prices, right? So I'm going to come at you fast with a couple of data points on that here. So looking at foreclosures, you may have seen, hey, foreclosures are up, they're concerning and so forth. But if we look at big picture, yes, they're absolutely up from when there was a moratorium on foreclosures. I think we've talked about this before for some folks that tune in regularly to us, but we are nowhere near bubble burst levels. We are nowhere near abnormal levels. We are actually in relatively reduced levels in the historic perspective. So that's not something to necessarily think that there's this massive wave of affordability issues. And one of the big reasons there is, sure, we have, you're probably seeing concerns on consumer debt, and that's a whole other thing. I'm not going to get into that, but certainly mortgage debt has risen based on the cost of homes. But look at the orange bar here as far as then equity, right? So sure, we owe more on homes than we ever have. I believe that's a correct statement to this date. But the amount of equity in those homes is massive, right? So yeah, and that's, I do not believe we'll see a massive correction or depreciation on homes, which we'll talk about here in a second. But even should we see that, the level of equity is going to protect so many folks from foreclosures, or if they're seeing values go down or they lose a job or something of that nature. Not to sound insensitive of it, they'll be able to sell and make money, right? Not necessarily be in a situation where they're upside down. So it's definitely not something that I think is looming out there and kind of a boogeyman that we need to be afraid of in 2025. This chart, I'm going to, please pause on this and just, digest here to be able to say demographics. We've spoken so much about that in demand, right? We have to say, okay, well, if we have people that want to buy homes, how many people versus the inventory available versus, how's that going to impact pricing and speed of market, and what we're just seeing here. And I'll just give you a wide summary. You can stop and pause on this here just because there's so many detailed analysis in this chart to be able to say, again, if we just chart historically speaking on generationally at certain ages, what we can expect population wise and demand wise, we can see that there is this massive amount of homeowners coming to market. And we know that the millennial wave is larger than the boomer wave, and we haven't seen a population near this for 50 years. And so in short sentence on this, and I could give you another 10 slides to dive into this and support this, but it's just, there are simply more households coming to market. So people needing to buy or rent or, and in the next coming years versus available inventory. So that's where this gets to be a little bit of a crunch, right? If there's more homes out there than people that want to buy them, that's when we're going to see prices go down. But vice versa, right? We are seeing more people out there than homes available for them. And so if we look at then wrapping this up here, guys, with a, let's see here, appreciation forecasts here, right? And grabbing a whole slew of different experts and economists, with the median number there being 3%. Keep in mind, Flagstaff tends to run above the national, just with their little landlocked situation here and small town feel and island economy, to where that could likely be a 3 to 4% estimate for the Flagstaff market. So generally speaking, it's going to be I believe there's going to be a lot of positives in the market. I would definitely encourage folks to make plans early, just in general, right? We don't have a crystal ball, but be able to watch these things, connect with us early, connect with your real estate professional, and get on top of your plan, because there is going to be some great opportunity out there for you. Let's make it a great 2025. All right, thanks for watching.